Hi, welcome to today's episode of Heard and Seen Around. I'm Rajesh Kadipurath, and this is a collection of things that I find interesting from India and from around the world. Things which I believe will have an impact on the economy, currencies, interest rates, and such in the days ahead. I hope you enjoy watching it as much as I enjoyed curating it. Thank you. On Friday, we had the latest US jobs data. The bars in this chart show monthly changes in non-farm payrolls, while the line represents the unemployment rate. For August 2025, job creation slowed sharply, with payrolls rising by just 22,000, well below the typical monthly averages for the past few years. At the same time, unemployment rate edged up to 4.3%, marking the highest level since 2021. The broader trend highlights a clear cooling in the labor market compared to the strong gains seen in 2021 and 22, with momentum gradually slowing through 23 and 24 and into this year. This weaker than expected report reinforces concerns about a softening US economy and could influence upcoming Federal Reserve policy decisions. So after the jobs data on Friday, markets now factoring a 100% rate cut expectation for September, with 85% for October and 78% for December. So basically, three rate cuts for the financial year. Treasury Secretary Scott Bessent came out with his criticism of the Federal Reserve, not surprisingly, and he's been pretty consistent about it. President Trump also, not surprisingly, jumped in. His too late uh, narrative is back. This chart shows bond market volatility using the MOVE index. After sharp spikes during the SVP crisis, the 2024 election, and most recently on Liberation Day, volatility has steadied quite a bit. Today, the MOVE index is back near its lowest levels since early 2022. Despite political risks, Fed uncertainty, Fed policy uncertainty, tariff shocks, the bond markets have stayed remarkably calm, a sign that turbulence is fading. Tariff revenue since 2010. For years, monthly collections were relatively stable, averaging a few billion dollars. That began to shift after 2018 with trade tensions driving a gradual rise. But in 2025, the revenues have exploded, jumping to nearly $30 billion a month, with about $10 billion coming from tariffs on China alone. This surge marks the biggest tariff windfall ever, equal to almost 1% of the US GDP, turning tariffs into a powerful fiscal tool as well as a geopolitical weapon. Keep rising. So, why does gold keep rising? Even when the traditional drivers don't support it. On the left, you can see that in the 2010s and the 20s, the usual factors, the dollar, the Fed, the stocks, and inflation, all delivered negative contributions to gold's performance. Yet gold prices surged. The answer lies on the right. Central bankers have been massive buyers with demand climbing to record levels to about 1,000 tons a year. That sustained buying has created what the markets have been calling the gold put. Central bank demand acting as a floor for gold prices. Shows that major gold hoarding episodes are often precede economic downturns. From the Panic of 1819 to the Great Depression to the 1970s stagflation and even the 2008 global financial crisis, sharp increases in gold demand have frequently foreshadowed recessions. The current cycle is no different. Since 2020, central banks and investors have piled onto gold, driving prices to record highs. If history rhymes, this surge could be another warning sign of stress ahead for the global economy. market continues to trade at a premium. High ROE sectors like FMCG, IT, autos, and oil and gas, together a third of the market cap, have consistently delivered superior returns. But since the pandemic, much of the premium has shifted to weaker or cyclical sectors, with telecom and consumer services trading at extreme multiples. The paradox is clear. India's market still looks expensive overall, but the quality of the drivers behind the premium has weakened. Indian companies are cash rich, but their cash to market cap ratio is shrinking. Corporate cash holdings have risen directly steadily since 2020, now topping 11 lakh crore rupees. But market valuations have grown even faster, pulling the cash to market cap ratio down from the above 6%, down from above 6% in 2020 to under 4% today. Message is clear: while balance sheets are stronger than ever, valuations have run ahead, making markets look more expensive related to corporate cash buffers. So, who's driving investment in India? Households remain the largest contributors, with their share rising from about 12.5 trillion rupees in FY20 to over 13.5 trillion in FY24. Corporate investment has been steady but flat, but hovering around the 11 to 12 trillion rupee mark, despite strong cash balances. The government's share has inched up slightly, while PSUs have added modestly to the title. The big picture: households and the state continue to lead India's capex, while corporates remain hesitant to step up despite having the firepower.